Good Sunday, folks. This is Craig, the options linebacker. This is the weekend report for Sunday, February 6th. Start off by looking at the different index charts. We have the Dow on the left-hand side. We have the transports on the right-hand side. If the Dow companies build a product, the transports ship it, but we're seeing a little bit of a non-confirmation here as the Dow just keeps ripping higher and is finally going parabolic. However, the transports are not following. Still in a primary uptrend, no doubt, but below the 50-day moving average, well separated from that 200-day moving average, and not moving at the same pace as the Dow Industrials. Now, anytime we have a non-confirmation between these two Dow components, that's reason for pause for us to kind of peel back the layers and say, what's going on here? Is this a leading signal? Nothing really wrong here with the growth stocks. We have the NASDAQ Composite on the left. We have the Russell 2000 on the right. The Russell is taking a bit of a pause after a monster run and is finding a little bit of resistance right around the 800 level, but this is more than likely just a consolidation zone. Now let's take a look at the S&P 500 with top-down analysis starting at the monthly chart. Nothing really wrong with the monthly chart so far. This is wave 1 up, wave 2 down, and wave 3 up. Now wave 3 should not be the shortest wave of these. So we would expect to see a very powerful wave eventually on wave 3, perhaps carrying up to 1500 to 1600 by the time that this thing is through. And as we've seen, these primary waves in the monthly chart can last for a year or longer. Last week we had some doubt about whether January was going to show up as a shooting star, but Monday's price action, which finished out the month, was just enough to be able to raise the closing price well above the half point for the month and cancel out that shooting star. So no real weakness other than just a little bit of profit taking the previous Friday. You can see that February is off to a good start already, and the next level of resistance will show in the weekly chart. Here's where things get a little bit more interesting because we can see that this overhead resistance at 1313 from August of 2008 is still in place, although I don't see this as a whole lot of overhead supply. Overhead supply is the concept of people that went long back at this level and are dying for the chart to just go back up again so they can be made whole, cash in their positions, and break even on their original position. Now, do you really think that somebody that went long back here in August of 2008 has been sitting there holding this whole time just waiting to wash their positions so they can go back into cash? I don't think so. So I don't think we have so much overhead supply as we do a potential profit-taking point here up at 1313. So if you're long from either early September or beginning of December, you're going to look for obvious places to take profits because you're not sure if there may be an issue up here. The other thing about this chart is that we've seen these very consistent swings on the weekly chart of the S&P. So about 289 points, 281. The fifth wave, the exhaustion wave, was much shorter, and that's normal. But off of the late August bottom, we've already put in 271 points. So it's almost up to the level that we saw in 2009 off of these primary trends. Now, this is a monthly wave 3, I believe. I don't believe this is just an ABC correction back up like so many bears do. If that was the case, then we wouldn't see the Russell near all-time highs. We wouldn't see the NASDAQ completely blowing past the 2007 highs, as it's close to doing. So the S&P is also above the 61.8% retracement. So I believe this is a monthly wave 3 impulse wave to the upside. So this does have the potential of being a very strong wave as too many people have no confidence in this and the market just keeps chugging higher on this wall of worry. We'll find out within the next week or so if we're able to hit this target up here. Certainly 1313 is just a blip away, and my eventual target is up around 1320, which would match the 281 point swing on these. So we could see some profit taking in the next week. As we talked about before, if we do actually get into a corrective period, which we're long overdue for, perhaps it's going to go down about 80 to 100 points, and that would put it at a support level, 1220, 1230, maybe just a little higher than that now. And then we head for the eventual impulse wave higher later on this year. Now this corrective swing is not going to happen until all the bears finally just toss their cookies and say, look, this is ridiculous, you just can't fight the Fed, and they start going long. If everybody goes long, then this is when we'll see this type of move. After what we thought was a corrective period starting last Friday on the 20-point move lower, and we see the index closing higher after just a few days, this has got to be incredibly disappointing to the bears, and they've got to be close to that point of total capitulation. Now, on the daily chart, none of these technical analysis signals are really worth anything right now. We're seeing, your typical bearish divergence on the MACD histograms, useless. The chart keeps going higher. We're seeing crossover after crossover after crossover on the stochastics. We're seeing all kinds of bearish divergences on the stochastics. All of these have been absolutely worthless. These are just not usable leading signals at this point right now. This is a market unlike any that we've seen in the previous few years. Why is this happening? Well, really, it's got to be the Fed. When you're the Federal Reserve, what they're trying to do is they're trying to force interest rates to be lower. So what they're doing is they're publishing a schedule, believe it or not, that is illustrating how much that they're actually pumping into the economy every single day. And you can see that we have these numbers right now, and we can see that on Monday, they're going to be pumping another additional $7 to $9 billion in. On Tuesday, another $1.5 to $2.5 billion, and on Wednesday, $6 to $8 billion. Ho hum, a couple billion here, 6 to 8 billion there. It starts to add up, doesn't it? Now, this is their original primary objective, was as measured by the 10-year note right now. So this is interest rates on the right-hand side. So this is 2.6, 2.8, 3.2, 3.4%. And what they're trying to do is they're trying to keep interest rates low. And this is when they began the program back around this time frame here. And it worked for about a month in keeping interest rates low. But what they're succeeding in doing is starting to drive inflation into the economy. Bond market is probably the smartest market that's out there, able to see things before they actually happen, and what they're doing is they've actually turned it around. We have a change in polarity in the yields of the bond market, and now we're up to 3.6% and breaking out of this consolidation pattern here, looking like it's heading much higher. So it's certainly anticipating a recovery, yet the Fed is keeping their foot on the gas, afraid to let up at this point. Now, the reason that they're keeping their foot on the gas and are afraid to let up as far as these liquidity injections into the bond market is because of the employment situation. We're showing negative divergence already on the employment situation. We had a big miss on Friday's jobs number. The market rallied because they knew that the Fed was going to have to keep their foot on the accelerator, keep rates low, interest rates essentially at zero, and keep feeding money into the bond market through this QE2 for the near future. And as a result of this, we're seeing the stock market go absolutely ballistic. You can see the two largest sectors of the S&P 500. Energies have been going crazy ever since September because they're anticipating not only the inflation of the commodities that are underlying for energy, but as well as the eventual recovery. And the financials are ready too, and they're also rallying, so it's in this big cup with handle pattern that we expect to break out above here at some point. So ultimately here, the bottom line is that market is going to be higher as long as the Fed wants the market to be going higher, but the minute that they start withdrawing support or turning down support, we could have some very heavy instability in the markets. Now, playing a neutral trade like the Iron Condor can still be done in this type of market because you still have some periods of consolidation as well as some protective trades that we've added here. So this is our high probability condor for the March cycle. So we have plenty of room on this and a nice wide profit zone, and we're well hedged off. If you know how to hedge these positions, this is our XSP low probability Iron Condor. The price is actually outside of our original profit range of the Iron Condor, but the way that we hedge this allows us to still take early profits on this position and end up with a nice cycle. That's it for this weekend's report. Enjoy the Super Bowl, and we'll catch you next weekend, folks. Take care.